Hey everyone, welcome back to my channel. Today, I'm super excited to share with you a summary of the book, Learn to Earn, by Peter Lynch. Are you tired of feeling lost when everyone around you talks about the stock market and their latest investment? Well, today we're going to change that. We'll be diving into the world of investments and learning all about how to make smart financial decisions. We'll start by exploring the history of investments and how Dutch merchants created the first mutual funds over 400 years ago. From there, we'll learn about the creation of the Dow Jones Industrial Average and the forces that guide the markets. And here's a fun fact for you. Did you know your closet could hold the key to your next investment? That's right. We'll show you how to use your everyday life to make better investment decisions. By the end of this video, you'll have a solid understanding of how the economic system works, why markets rise and fall, and what affects stock prices. So join me as we learn to earn together. Idea number 1. Are you ready to join the club of corporate America? Investing in stocks is your ticket to owning a piece of some of the biggest and most well-known companies out there. From Colgate to Jeep, Starbucks to Nike, you interact with corporations every day. But did you know you could be a part owner of those companies too? But wait, what is a corporation? It's just a fancy name for a company. And anyone can start one, all they have to do is pay a fee and file papers. But there's a difference between private corporations and public corporations. Private corporations are owned by a few people, like your local family-owned restaurant. But public corporations, like Nike or Coca-Cola, are open for anyone to buy a share in. And the best part? It doesn't matter who you are, as long as you have the money, you can play in the stock market game. Investing in stocks is a true act of equality and democracy, and the earlier you start, the more you can earn. But we know that many young people don't fully understand how the stock market works. So, let's change that. Join me as we dive into the world of stocks and learn how to own a piece of corporate America. Idea number 2. Are you ready to dive into the history of capitalism? Buckle up, because we're about to take a wild ride through the past. Once upon a time, people lived a very different life. The wealthy landowners ruled the roost and serfs worked for their daily bread. But then, something amazing happened. Capitalism came onto the scene and private individuals started owning businesses for the almighty profit. Can you imagine the thrill of being a part of the first joint stock companies in the 1600s? Dutch merchants were pooling their resources and sending ships on trade expeditions to far-off lands like India. And when they returned with goods, they divided the profits. The United Dutch East India Company was one of these companies and even played a role in the purchase of Manhattan. The Mayflower may be known for the Pilgrims and religious freedom, but it was also an early example of a joint stock project funded by British merchants. As the 1700s rolled around, nations were trading, markets were thriving, and money was flowing. People were making more money than ever before and capitalism was on the rise. Enter Adam Smith, a Scotsman who was fascinated by these developments. He wrote The Wealth of Nations and argued that economics had natural laws like science. He talked about the invisible hand of supply and demand and the law of accumulation, which states that as companies become more profitable, they can expand and create more opportunities for others. And with that, capitalism was off to the races, especially in the new nation of America. In just 3 centuries, it had become the leader in growth and ingenuity. Wow! Talk about a transformation! So there you have it, folks, the brief history of capitalism and how it paved the way for stock markets. Idea number 3. Did you know that banks, politics, and some serious brainpower helped shape the rise of American corporations? It's a wild ride, I tell ya. Back in the early days of the U.S., banks had a rocky start. Andrew Jackson, the 7th Pres, was all about keeping the central government in check and transferred national bank money to state banks. Each state issued its own currency and the value of each varied, making the banks a bit unstable. But, despite all that, entrepreneurship was thriving. By 1800, 295 corporations had formed and a few even offered stocks for the public to buy. Trading took place under a tree on Wall Street and later moved to rented rooms and coffee houses. Until one day, a fire forced traders to move to a nearby hayloft. Talk about a change of scenery. From the 1790s to the start of the Civil War in 1861, the economy saw some serious growth in industries like factories, mines, railroads, ranches, insurance, and canals. And who can forget the appearance of household names like Oreos, Heinz ketchup, and Campbell's soup? It was a time of growth and innovation. By the 1860s, banks had stabilized, a new federal banking system was in place, and the US dollar was the national currency. The 20th century saw the rise of automobile manufacturers and chain stores, and more people participated in the stock market. Thanks to a man named Charles Henry Dow, people could now keep track of the stock index by tracking the average closing price of the top 11 stocks. Of course, there were a few speed bumps along the way. A few wealthy industrialists tried to monopolize their industries, but the government stepped in to block them. And who can forget the great crash of 1929? But over time, the government learned how to pump cash back into the economy and lower interest rates during times of depression. And in 1934, the SEC was created to regulate and monitor all stock trading, setting the stage for modern-day corporate America. Idea number 4. Are you tired of just letting your hard-earned money sit idly in your bank account? Well, it's time to make your money work for you. Just imagine, you're walking through the electronics store and see that fancy smart TV that you've had your eye on for months. But wait, before you make that purchase, let's think about what Warren Buffett would do. You see, Warren has a secret trick to avoid impulse buys like this. He calculates what that same amount of money could do for him if he invested it instead. And guess what? The results usually make him think twice about the instant gratification. The earlier you start investing, the sooner your money will start supporting you. So, let's dive into the world of investments and learn about the 5 basic types. First up, we have savings accounts, which include money market funds, treasury bills, and certificates of deposit. These are backed by the government and super convenient, but the low interest rates make it tough to keep up with inflation and taxes. Next, we have collectibles, like antiques, vintage toys, or rare comic books. If you love researching and have a passion for these items, then this might be the investment for you. Third on the list, we have real estate. Investing in property can be super profitable. Just imagine paying $100,000 for a house and a year later, its value goes up by 3%, making it worth $103,000. That's a 15% return on your investment, not too shabby. Fourth, we have bonds, which are basically IOUs. You lend money and expect to get it back with interest. If it's offered by the government, then it's a guaranteed return, but keep in mind that it can have a timeline for repayment from 15 to 30 years. And last but not least, we have stocks. Buying a stock means owning a share of a company. If the company is successful, you may get a bonus or dividend. The best part? You don't have to be a genius, have a lot of money, or have fancy connections. All you need is discipline and patience. If you're looking for excitement, involvement, and high rewards, the stock market is the way to go. So, are you ready to make your money work for you? Let's get started. Idea number 5. Are you ready to dive into the world of stocks, but feeling a little overwhelmed by all the options? Well, don't worry. That's where mutual funds come in to save the day. Think of mutual funds as a guided tour of the stock market. Brokers and managers do the heavy lifting of putting together a portfolio of stocks from different companies, so you don't have to stress over picking just one stock. But don't just blindly trust them, do your own research too. The Investment Company Act requires each fund to explain their level of risk, so you can be informed about what you're getting into. And don't be afraid to check out trusted sources like Barron's and Forbes to see a fund's record. If you're feeling adventurous, a small cap fund investing in newer, smaller companies may offer bigger returns. Just be aware of any entrance fees, also known as loads. And if you prefer a more steady approach, an index fund like the S&P 500 index fund buys all the stocks in that index, ensuring you always earn the average. But hey, why settle for just one? Mix it up with a big index fund and a small cap fund, or even both. Just make sure to avoid funds that mix stocks and bonds and don't switch funds too often. Most importantly, don't sell. Stick it out for the chance at future profits, and you'll be glad you did. In conclusion, mutual funds offer a stress-free way to invest in the stock market, but if you're feeling up for a challenge, picking your own stocks can be a lifelong adventure. Idea number 6. Hold on a sec. Before you start buying stocks left and right, let's make sure you're equipped with the right mindset. When it comes to investing, it's not just about putting your money where your mouth is, it's about being in the know and having a strategy in place. First things first, you need to start thinking like an investor. That means paying attention to things you never considered before, like the companies you already support in your everyday life. Are the employees at the gym you love happy and motivated? Has your favorite skincare brand recently seen a surge in popularity? These are all signs that a company is doing well and could potentially be a smart investment. But wait, before you jump in headfirst, there are a few different ways people approach investing in stocks. Some folks prefer to throw caution to the wind and make random choices, like throwing darts at a stock list. But let's be real, relying on luck is not the safest strategy. That's where mutual funds come in. They let a professional take care of the stock picking for you. Others might get their advice from hot tips from friends and family. But remember, unverified information is never a guarantee. That's why some investors prefer to stick to lists put together by professional analysts, for a bit of added security. But for those who love to roll up their sleeves and do some digging, investing in stocks can be the ultimate thrill. You can do your own research by checking out the company in person, seeing how it's run and how its employees are doing. You can also take a closer look at the numbers, like how much debt the company has and whether it's paying good dividends. If everything checks out, it could be a wise investment. So, you see, investing in stocks doesn't require a degree, just a little bit of work and research. And who knows, you might just hit the jackpot and see your stock value triple what you paid. Idea number 7. Remember that choosing stocks is all about balancing the numbers and the stories. You've got to get a grip on both to make the best decisions. Let's start with the basics. Stocks are traded on exchanges like the NYSE, the oldest one in the world, and the Nasdaq. Traders look at the closing price of a stock when making buy or sell decisions. This is the last trade of the day, which happens at 4 p.m. But to really know if a company is a good investment, you need to dig a little deeper. Check out its balance sheet, see how much debt it carries, and if it pays good dividends often. Look for big companies showing around 10 to 15% growth per year and small companies showing around 25 to 30% growth. Also, take a look at the earnings. For example, if a stock earns $10 a share and you buy a share for $100, the price to earnings (PE) ratio is 10, which is a good deal. But if the stock earns $1 a share, the PE is 100, which makes it expensive. Compare the company's PE ratio to the average or index of a large group of companies to get a sense of what's reasonable. Now, let's talk about what the company does with its profits. Does it use it to grow the business or blow it all on lavish corporate bonuses? Some companies buy back stocks to raise the value of stocks left on the market, while others pay stockholders dividends. Don't forget about the story behind the stock, too. Read the news, understand the industry, and check out the quarterly reports and fancy annual reports that give you the complete picture of a company's performance. Doing your research and reading thoroughly about a company can help you make a smart, long-term investment. So there you have it. A quick and fun rundown of how to choose stocks. Idea number 8. Stocks are like a roller coaster of ups and downs, twists and turns, but with the right strategy and mindset, you can come out on top. Let's start with the life cycle of a stock. Think of it like the life cycle of a butterfly. It starts as a tiny little egg, the company's initial public offering, then emerges as a young and spunky larva. The company offers shares on the stock exchange, then matures into a reliable and evolved middle-aged butterfly. The company evolves and grows, and finally, becomes an old and wise butterfly. The company is a safe and reliable investment. But wait, there's more. The stock market isn't just a standalone entity, it's affected by the economic climate it lives in. Just like the weather, the economy has hot and cold phases, with the Federal Reserve System, the Fed, being the meteorologist in charge of regulating the temperature. When the market is on fire and prices are rising, it's a bull market, everyone wants to buy. But when the market takes a dip and prices fall, that's when you need to hold onto your hat, it's a bear market. But don't be intimidated, a bear market is just a temporary setback, and the bull market will come back eventually. So, what's the key to success in the stock market? Patience and determination. Don't be afraid of the bear market. If you miss out on the bear, you'll also miss out on the bull when it comes. Make smart investments and hold on for the ride, and you'll see worthwhile rewards in the end. Summary. Get some practice with a fantasy investment portfolio. Just like fantasy football, you can build a roster of stocks, track their stats, and see which ones come out on top. It's a great way to get a feel for the market and make informed decisions when it comes to real money. Remember, investing in the stock market is not just a profitable venture, but it's also a lifelong journey full of excitement and learning. So, what are you waiting for? Let's get started and make that money grow. Now, the insights and knowledge I gained from reading Learn to Earn were phenomenal. I highly recommend it. Thank you for taking the time to watch, and if you found value in this video, be sure to hit that like button and subscribe to my channel for more great content. Trust me, you won't regret it.